This screencast is focusing on Summer 13 Question 2, Crystal Limited, with a particular focus on advanced variances. So have a look through the question, pause the screencast now, make sure you look through the requirements and the fully of the question before you begin. So part A of this question looks at calculate the total labour mix variance and the total labour yield variance. So again, as a quick recap, if you're struggling on labour mix or labour yield, which is the same concept as material mix or material yield, go back and look at the Clark textbook, chapter 15, page 629 to 633, and you'll see good examples there. So as a quick recap, the material, so we're looking at materials, you can also look at labour, and we'll do the question on labour as well, the same thing, just different terminology. So your material usage variance can be split into two. It can be split into material mix variance, which essentially looks at the change or the expected impact on profit from using a different mix of materials. And likewise, you can also use a material yield variance. So that is the difference between what you thought you would get out of the inputs you put in and the actual output. And there's one approach for here, it's a table approach that I'll show you next, and there's two approaches to calculate the material yield. Now this approach is also the same if you took labour efficiency variance. So the labour efficiency variance will be made up of a labour mix variance and a labour yield variance. And remember, to have a mix and yield variance, you need multiple types of labour or materials, and they need to be charged or cost different amounts, because otherwise there's no real need to mix or change the mix of materials, because you may only have one material. So the requirements are you have to have a number of different materials or a number of different grades of labour. They have to be interchangeable, and you also have to cost different amounts. So the way you should approach mix and yield variances, again either materials or labour, is set up a table. So for material mix, where you want to compare the actual mix to the standard mix, you do AQAM for one column, so actual quantity, actual mix. Compare that to actual quantity standard mix. So you can see the quantity stays the same, all you're worried about is AM versus SM. Then you take the difference, you multiply by that standard price, or if it's labour, the standard rate, and you get the variance. And this total of the variances is your material mix. One important thing to note is make sure you're careful with your labelling, whether it's an adverse or a favourable variance. For yield, you can also take a table approach. This time you're looking at standard quantity here, standard mix, compared to actual quantity standard mix. So in this case, the mix stays the same. You're comparing standard quantity to actual quantity. Again, same approach as above. You take the difference, multiply by the standard price, and you get your variance. There's also an alternative, shorter method called the total method for the yield variance, where you compare expected output for a given level of inputs with the actual output. And we'll show you that method as well. It can be confusing for students at times, so just be aware you can use the table as well. We will get to the exact same answer. So if we go back to our question, we're told here we need the labour mix variance and the labour yield variance. So we're given information here about the labour for 2012, both budgeted labour for 2,500 units and actual labour for 2,500 units. So you'll note here there's three different types of labour and they're different prices, and they can be used interchangeably, therefore you can have mix and yield variances. So the first thing I suggest to students is set up your table for the mix. So the table, as we've seen here, AQAM, AQSM. So we have here AQAM, AQSM, we have diff, we have standard price or standard rate, so we should have here AM, so actual hours, actual mix, actual hours, standard mix. So you can use either hours or quantity as long as you understand its labour, and then we will get variance. So we have three types of labour, type 1, type 2, type 3. So this is essentially just giving the information you have, the actual hours, the actual mix, and that is the actual information here. 4,800 hours, 2,100 hours, and 3,250, giving you total hours used of 10,150. So that is the balance there. Now you're doing actual hours standard mix. So it's the actual hours again, but now we have to do the standard mix. And the standard mix is essentially from the budgeted information. You expected to use in total 10,000 hours. 5,000 plus 2,000 plus 3,000. Of that mix you expected to use, so type 1, just take it from up here. So the standard was 5,000, 2,000, 3,000, giving you a total of 10,000 hours. So to get the standard mix, you just look at the relationship. It was 5 over 10, which is 50%, 20%, and 30%. So now you take the actual hours, which is 10,150, and you use the standard mix, i.e. this ratio here. So it's 10,150 times 0.5, 10,150 times 0.2, and 10,150 times 0.3. So you'll note the actual hours don't change. The only thing you're changing here is the mix. You expected this mix 5:2:3. You actually got this mix. So now we're comparing the difference. Well, the difference here is 4,800 place 5,075. 275 is the difference. The difference here is 70. And the difference here is 205. Now we put in an extra column here just for Excel purposes. It's always good discipline to label it whether it's an adverse or favourable variance. This is your actual mix. So this is what you did use. This is what you would have expected to use based on the quantity of hours worked and the standard mix. So you use less than expected, therefore that is a favourable variance. So don't forget to label it. Students lost marks in 2015 because they didn't label the variances. Even though if you get them right, you need to label them as well. Here you used more than you expected based on the standard mix, so it's adverse. And likewise, for this case, you use more than the standard, so it's adverse. Remember, you're using the standard rate here because go back to the diagram. Price variances here are separate issue. So the price variances are anything to do with actual price. That is stripped down to this variance. You're worried here in this circle, so you're only going to use the standard price because price variances are captured elsewhere. So we go back to the question. The standard prices or rates here are 25, 35, and 18. So now all you take is the difference in hours times the rate gives you your variance. So variance is down along. Now, note here, this is a favourable variance, and the other two are adverse. So be careful when you're adding them up. So this is favourable, which is a plus, minus the 2450, minus the 3690, giving you a 735 favourable variance. So it's very important to note there, be careful with your positive and negative, depending on whether it's a favourable or adverse variance. So that is your material mix. That's the labour mix variance, 735 positive. So that's essentially telling you that you need to be able to interpret the variance as well. Well, we used less of type 1, but we used more of type 2 and type 3. And the saving we made in using less of type 1 outweighs marginally the extra cost incurred with type 2 and type 3. So you made a saving in terms of the mix. But now the more important point, and the separate issue as well, is, well, how efficient were you at turning the number of units? So you expected before that 10,000 hours would get you 2,500 units, but now we know we had to do 10,150 hours for the same number of units. So it suggests we're less efficient than we would have budgeted for. So let's now do the back here, the labour yield variance. So this is material yield, same principle. We're now looking at this table here. SQ or SH, standard hours, standard mix, actual hours, standard mix. So we have here, in terms of SHSM, AHSM, the diff, we'll leave that, standard rate, and the variance. And again, similar approach to before. What's the standard hours, standard mix? Well, if we take up here, standard hours is the 2,500. Actual is the same as budgeted in terms of units, so no adjustment. It is 5,000, 2,000, 3,000. So we'll add them up. We know our standard hours are 10,000 hours, which is up here. Actual hours, standard mix is up here. We've already calculated, so don't reinvent the wheel. Be efficient. So we've done that calculation. So you see here, we're not worried about the mix. What we're looking here is the total is different. The total standard hours is less than the actual hours. So this is the formats. Now we take the difference. The difference here, 75. Difference here is 30. And difference here is 45. So again, remember what we're trying to do. We're now looking at the labour yield. So we're saying, based on what we expected the number of hours required to make the number of units, we thought we would take 10,000 hours to make 2,500 units. It actually took us 10,150. Therefore, we performed worse than we thought, but we want to now quantify that. So here, the difference is 75. Is it adverse or favourable? Well, our standard hours are less than our actual, therefore it's adverse. We used more than we expected. Same for type 2 and same for type 3. Now we ended up, for each type labour, we ended up using more than we expected. The rates stayed the same, i.e. the standard rates, and then we calculate across. And of course these are still adverse all the way down. So in this case here, for our labour yield variance, each of them are adverse. We used more than we had expected to use based on our standard hours. We expected to use 3,000 hours of labour for type 3. We used 3,045 based on the standard mix. So we don't worry about the actual. We're stripping out mix here, and we're only worried about hours here. So the mix is still the same here. It's 5:2:3. Now we're only worried about the actual quantity, which we know is more. So adding them up is an adverse variance of 3735. So we've now calculated for 6 marks our labour mix variance, which is positive. However, the labour yield variance is negative. So if you're asked to interpret that, which aren't here, which is important, you're saying we saved some by using less type 1 labour, but overall we were less efficient than we would have budgeted for, because we used 150 hours more to make 2,500 units than we would have based on the budget. Right, so that's the first part, labour mix, labour yield. Now, as I showed you in the slides earlier, there is 2 methods of doing the material yield. There is the tabular method, as we've gone through. However, we can also approach it from a total method as well. So looking on a total basis. So we know that the actual information was 10150 hours gave us 2,500 units. Right, so 10105 hours gave us 2,500 units. However, based on expected or budgeted, the 10110 or 10150 hours should have given us how many units? Well, we know 10,000 hours gave us 2,500 units. Therefore, expected 4 hours per unit. Therefore, 10,150 hours should have given us, divide by 4, 2,537.5 units. Therefore, overall, based on what we put in, i.e. 10,150 units, we had a shortfall of 37.5 units. So we had a shortfall of 37.5 units between what we put in and what we thought we were going to get out. And that's the total method there. You compare that. So now those units, and we want to figure out what was standard labour cost per unit. Standard labour cost per unit, well, we're going to have to figure that out. First, we have to figure out what the total expected labour cost was. So expected labour cost, well, we just add up all the expected costs. It's 5,000 times 25 plus 2,000 times 35 plus 3,000 times 18. So all we're adding up is we're saying, based on what we expected, these number of hours times this rate, we expected to pay 249,000 on labour. The number of units we expected to make was 2,500. Therefore, expected labour cost per unit was 249,000 divided by 2,500, 99.6. So we then get, well, if we were short 37.5 units, and each unit cost 99.6 for total labour. So this is the total. We don't split it out to type 1, type 2, type 3. We look on a total basis times 99.6 gives us 3735, and of course it would be adverse because we were short. and note that 3735 equals the 3735 that we calculated using the tabular method. So again, either are acceptable. This one is probably a bit shorter if you know how to go about it, but again, just make sure you're comfortable with using both approaches. Right? So again, that's getting back to tabular method, but also there's a total method as well. So that's part A for 6 marks. We're now looking at part B. From the perspective of Crystal's use of type 2 labour only. So we're only looking at type 2 here, so the middle one in each box. For 2012, calculate the following 6 variances. The labour rate variance, labour efficiency variance, before adjusting for planning and operating, then labour rate planning, labour rate operational, labour efficiency planning, and labour efficiency operational. So the first one, we'll do the 2 basic ones, and I always advise students, look, start with the easy ones first and get them out of the way. So the very basic ones, labour rate and labour efficiency. So the way I always do labour rate and labour efficiency is, you do 3-column approach. So the actual AH times AR, then you compare that to AH times SR, and then you compare that to SH times SR. So here you're comparing actual with actual hours times standard rate. This gets you the price variance, and then this gets you the efficiency variance. So everyone has their own way of doing it. In this case here, we're looking at the actual hours is 2100 times 34 euro per hour. Here. It's not letting me do it. So you can see where it's coming from. So 2100 times 34. Here the actual hours is still 2100, but now we're using the standard rate, which was 35. So that total gives us 71,400, and this total gives us, so we compare both of them. Our actual 71,400 are what we expected based the actual hours and standard rate was 73.5. Therefore, the variance is 2100, and it's going to be favourable. Why is it going to be favourable? Because if you look at a high level, what you actually paid, 34 euro per hour, is less than what you expected to pay. Similar approach here. Standard hours that you're going to use is 2000. You don't need to adjust for units. It's 2500 units, 2500 units. And that is times the standard rate, which is 35. That gets you to 70,000. You compare that to 73,500, gives you a variance of 3,500, and your actual hours were more than your standard hours, therefore that's going to be adverse. So the way you look at it here, you used 100 hours more than you expected, so standard hours is 2,000, actual hours 2,100, therefore the adverse variance of 3,500, meaning a total variance overall of plus 2,100 minus 3,500. So it's a variance of adverse variance of 1,400. So you can just put in minus 1,400 or 1,400 adverse. Either is acceptable. So that is the very much Cap 1 style of variances. Labour rate, which is this one here, and labour efficiency, which is this one here. You can put in the total if you want. It'll be useful in a second what we're looking at. These now get onto Cap 2, your advanced variances, planning and operational. Again, a quick recap. Go back to, they're called revision variances in the textbook. They're covered in the slides as well. Look at chapter 15. These essentially planning and operating variances are where the standard is now incorrect, either due to bad planning or something happened that you want to change the standards that you're using. So now you will have a revised set of standards. So you still compare actual, but now you compare the actual to the revised standard. That will tell you how good from an operational perspective you are. So the operational or operating variances. The other set of standards that you have is original. So you'll then compare the updated standard to the original to what's called planning variances. So this really has nothing to do with the operational side of the business. It's merely due to changes in plans or changes in standards. So would you typically use these variances to measure a manager's performance, these variances to see how to essentially strip out any impact of incorrect standards. And I always tell students, take a three-step approach here. Firstly, there's always going to be three sources of information when you're dealing with planning and operating variances. You'll have your actual information, which we have in the question, and you'll have the original standard, which we also already have in the question. What you will then be given is revised standards. So perhaps both elements will be revised, both the hours and the price, or perhaps only one of them will be. That will depend. Then, and you'll notice what I do here, you compare actual to revised. So compare these two to get your operational variances, step 2, and these are used to gauge performance. And finally then you compare revised to original, step 3, to get your planning variance. So again, there's nothing new here. You're still calculating the same variances. You still have two sets of benchmarks you compare to calculate a rate variance and an efficiency variance. You're just doing it in a different context now. So remember the three steps. Set out a table of the three sources. Step 2, calculate your operational variance. Step 3, planning variance. So back to the question. First thing is, read the information. You say, Joe discovered that a resulting accounting error, the standard rate of pay for 2012 for all type 2 labour should have been $32.50. So that's essentially saying the standard is stale. It shouldn't have been 35 up here. It should have been $32.50. Likewise, due to intensive training at the end of 2011, all type 2 labour, the standard amount of type 2 labour hours required for each unit should have been 0.75 hours. So we have to figure out, well, the standard here was 2,000 hours, but we know it should have been 0.75 hours per unit. So firstly, do up your table. So we look at here, what was the actual, what was the revised, what was the original. So a little table like that, we'll do it here. So the actual in terms of hours and in terms of rate. So the actual hours was 2100, nothing changed there, and the rate was 34. The original, again, just put it in for basics for now, was 2000 and the rate was 35. We know the revised rate based on the question here is 32.50. We now have to figure out, well, what's the revised standard? The revised standard is 0.75 hours per unit, so it's 0.75 times 2500, 1875. So now we have the table, step 1, and you'll notice the same numbers that I used for the slide. So now let's calculate here op variances, and here planning variances. Alright. And one thing of why I want you to note here is the overall variance 1400 here that you've calculated already. When you do out, all you're doing now, as asked in the question, is we've calculated the rate and efficiency already. All we're now doing is splitting those into their planning and operational elements based on what's going on up here. So what you're going to end up is the total overall variance when you add up them for rate planning, rate op, efficiency planning, efficiency op, is going to be, the total of them is going to be the exact same here. Now note, the total of the rate will not equal here. There will be a bit of overlap between each of them. So all you're looking for is the total of all the four here will equal 1400 as well. So that's a good sense check overall, that you'll know that the total of planning and operating variances will come back to the total of the basic variances at the end. So again, go back to our steps. Now compare actual and updated standards to get the operational variances. So we're going to look at here, let's start with the actual hours times the actual rate. So you see a very similar approach to up here, where you have two bits of information and all we're doing is calculating the standards. Here we have actual hours times, I call it revised rate. So you don't really call it standard rate because it's not, just in case you get confused and pull the wrong information. And finally then you say revised hours times revised rate. So same from before, so actually that should be rate. So no need to reinvent the wheel, you know this already is 71,400 from your prior calcs. The actual hours here is 2100 times the revised rate is 32.5. So you're getting it from here, revised rate 32.5, giving you 68,250. So you can see here, for the rate variance, now remember this is operating, your actual price was 71,400 paid. It's compared to the standard rate used would have been 68,250. Therefore, there's a variance of 3150, and that 3150 again is adverse. Why is it adverse? Well, the actual rate paid was 34. The revised rate was only 32.5. Therefore, it was poor performance compared to standard. Same approach here. Revised hours. Well, the revised hours is 1875 times the revised rate is 32.5. So calculate that out, giving you 60937.5. So you compare that, the difference being, just open that a second, the difference being here 7312.5. And again, ask yourself, always get the discipline, is it adverse or favourable? Well, here your actual hours are 2100, your revised hours, which you expected to be standard, is 1875. Therefore, it's going to be adverse because you worked more than you expected. So overall then, you can see both are adverse. You have an adverse operating variance for rate, which is this one here, and you have an adverse operating variance for efficiency as well. So you have two parts of the question done, your operating rate variance and your operating efficiency variance. Now you want to go on, step 3, compare original standard to updated standard. So these two here, these are your planning variances, i.e. discrepancies because the standard was out of date. So back to the question and set up, the formula. So you're going to have here, on one hand, you're going to have revised hours times revised rate. Then you're going to have revised hours times standard rate. And finally, then you're going to have standard hours times standard rate. So then you have to practice. These are just using these two now, revised and standard. Very similar approach to up here, 3 columns. You're just using a different label just to make sure you're comfortable with which figure to take, particularly in the heat of the exam, that you don't pull the wrong figure. So again, back to similar approach now, we calculate out each variance. So the revised hours times revised rate, again, don't invent the wheel, you have it done already in the prior one. Just bring it across, 60937.5. Revised hours here are 1875 times the standard rate, or what you can call here the original rate if you want it, or 35. That is, so we're comparing now a revised rate times the revised hours is 60937.5, and this is 65625. So there's a difference here of 4687.5, and it compares here, what you can see is, so if you're comparing the two rates, you're comparing 35 is to 32.5. So what we're saying here is 35 is the original standard, the revised standard is actually lower, therefore it's favourable. Right, so you're comparing as if this was actual. So this is the new standard you're comparing to the original standard. The new standard is lower, therefore it's favourable. It's cheaper to buy labour, so to speak, the rate. So that's favourable. The last one then, standard hours, which are 2000, or you could call them original hours, times the standard rate, or what's called the original rate. And then that gets is 2000 times 35. So comparing those two together, you have a difference of 4375. And the question is then in terms of, well, is that a favourable or unfavourable? Well, if you look at here, the original standard had 2000 hours. The revised standard now has only 1875. Therefore, you need less thanks to the new standard. Therefore, again, it's favourable. So you put in favourable. So now we've calculated the 4 variances asked, and again, just to confirm that the sum of these two variances, the 1400, i.e. the variance that we calculate, the labour rate plus the labour efficiency, even when you split them out to planning and operating, you're still getting the same overall thing. So it's a good sense check at the end if we sum them together. So we call this op rate, op efficiency, plan rate, plan efficiency. Just to get the sum of them together. So we put these as negative because it's a negative operating, it's a negative efficiency. These are positive because they're favourable. And adding those together gets you to your negative 1400, which again is consistent with our initial calculation up here. So again, it's a good sense check at the end to make sure that the 4. Now note that the two rates added together, 1537.5, don't add up to the total rate. They're not intended to. Don't get mixed up. You're only looking when you add the aggregate together. Right? So what does that tell us then? And again, you are not asked to interpret here, but again, it's important to be able to interpret. Well, we initially said, well, this looks very good. You made a good saving on your rate, so you have 2100 favourable because you bought it at €1 cheaper. However, you're a bit inefficient in terms of your efficiency. You used 100 labour hours more than expected for type labour 2. However, when we strip it out, we actually see, well, actually all that rate was to do with planning. We know that the actual standard you should have used is 32.5, hence you have a very good planning rate variance. And actually, if you were comparing for managerial performance, it was very poor. So you should have paid 32.50, whereas you ended up paying €34 per hour. So looking at this without doing a planning and operating variance masks the underlying true performance. The underlying true performance is you are a lot worse than expected. So it masks it if you don't split it out. Similar for efficiency. While we said efficiency was fairly poor here, well actually some of that efficiency was a favourable variance. Therefore the real underlying performance by the management team in terms of managing labour efficiency was very poor. It was 7,000. So this again masks a worse performance than actual is portrayed here, because you don't split out what the updated standard was. So that gives you two. It's these two variances here, the operating variances as signaled here, that should be used for performance measurement, because this is the updated standard that you should have, your manager should have been using as a benchmark. These other two variances here, the planning ones, comparing revised to original, is really just to strip it out, because it's nothing to do with managerial performance. It's really just to do with poor planning or your standard was out of date. Okay? So again, that was for 9 marks, giving you 15% of your paper, 15 marks in the question. The final one I'll leave you to do, again, this gets back to your understanding of how do I actually use variances for performance measurement and to manage the business. So you're told here, Joe is concerned that the type 2 labour, although the hourly rate has increased from the standard of 32.50 up to 34, efficiency is not improved, as we can see here. It's corroborated by the variances. He has consequently suggested that let's cut the hourly rate to 30, so cutting it from 34, which it is, down to 30 until the expected labour efficiency gains are realised. Critically evaluate. Couple of points here. 1. Watch out for the verb. Critically evaluate means discuss both the positives and negatives of such a plan. And again, make sure you use the information in the question. If you're going to cut down to 30, is that going to have the desired effect? You're really taking the stick approach here as opposed to the carrot. If you're going to say, well, cut to 30, that will have a demotivating effect. So there is somewhat of a link here between performance measurement, the section as well, in terms of how you should manage performance, set remuneration schemes, etc., and also your knowledge of variances. So for 6 marks, go back, have a look at the answer to the suggested solution, and see would you get some of those points. But again, key point here is you need to discuss on a balance, critically evaluate. Use the information in the question in terms of performance, information about the training, and also your own business common sense. If you threaten to cut your wages, will that have a demotivating effect, or will it have the effect that Joe thinks it will in terms of improving efficiency gains? There's the types of points that you'll have to tease out to get your 6 marks. So that was looking at advanced variances, question 2 on the summer 13 paper.